Hey everyone, hope you're having a great day. In this video, I want to provide you with an honest, straight to the point update on the overall economy. That means stocks, bonds, and real estate. That means wages, that means inflation and interest rates, and that means the car market. So you have a better understanding of what is going on in the economy and where we're headed in 2024. So let's do just that. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's talk about the economy. So first and foremost, we have to start with interest rates and inflation because 99% of the problems that we are experiencing right now come from interest rates and inflation. So we have to start there. So what is going on? The Federal Reserve right now is in the middle of a fight against inflation. And the reason inflation is high is because of quantitative easing, which took place in 2020 during the pandemic. I don't know if I can say that word on here, but basically what you had is you had a federal government that pumped trillions upon trillions of dollars into the economy to basically keep the economy afloat and to keep people afloat. And at first, that didn't really seem to have a negative impact on the economy. But that is because the economy was basically shut down, which means that this money was not really going into the economy. It was going into people's pockets and into people's savings, which is what's known as excess savings. It's the reason we've had excess savings for the last few years, which is savings above the standard savings rates. Now, the thing is that all changed in about 2021 to 2022 when the economy started to reopen. What you had is you basically had pent-up demand for everything from going out to vacations to eating out to buying things. And on top of that, you had consumers with extra money in their pockets. And on top of all of that, you had a supply chain that was still dealing with problems from a pandemic. So you had the perfect storm for a supply and demand imbalance. And remember, supply and demand is very simple. And we can actually draw a lot of economic conclusions from simple supply and demand. And what ended up happening is you had too much demand and not enough supply. And we both know that when there's too much demand and not enough supply, prices rise. And that is exactly what happened here. So you had inflation, which at one point was above 9% year over year. That is very high for the United States economy and by U.S. standards. So the Federal Reserve took notice and said, oh shit, this is bad. We have to do something about it because the main job of the Federal Reserve is price stability, which is basically a fancy term for making sure inflation stays near its target rate of around 2% per year. The Federal Reserve wants inflation at 2% per year, or very close to it. So when it is at 9%, there is a huge problem. So what does the Fed do? The Fed raises interest rates to fight inflation. Why? You have to understand why. You have to think of interest rates kind of like a lever, okay? When interest rates are low, it is basically putting money into the economy, and I'll explain why in a second. When interest rates are high, it's like turning the lever the other direction and taking money out of the economy. Because when interest rates are cheap, interest rates are basically the cost of money. So when interest rates are cheap, you and I can go borrow money for cheap or for less expensive amounts. Same with businesses, same with everything. So remember, businesses also borrow money to fund their ventures. So when interest rates are cheap, when interest rates are low, everything in general is cheaper. Now, when the Federal Reserve raises interest rates, you are basically making money more expensive. So that means there is a less flow of money into the economy. Now, this does two main things. First, it does fight inflation, but it can also, secondly, slow the economy. Because remember, the economy grows when the more money you put in the economy, the faster the economy is going to grow. The more money you take out of the economy, the more the economy is going to slow down. So the Federal Reserve has this balancing act of fighting inflation by raising interest rates, but trying its best to not cause a recession by removing too much money supply from the economy, which is basically the fuel to the fire. Okay, or the fuel to the engine. So it is constantly doing this balancing act. So what we have right now is we have a situation where the Federal Reserve, and basically in all instances, the Federal Reserve has made it very clear that it cares more about inflation control than it does about the economy. It doesn't mean that it doesn't care about the economy, but what it means is that the economy is secondary to inflation control. In essence, the Federal Reserve would throw the economy under the bus or will treat the economy as collateral damage if it has to do so in order to fight inflation. So inflation comes first. So what we have is we have a scenario where we are going to remain in a high interest rate environment until inflation starts to near the target rate of 2%. Now, here's the problem. It is already starting to show signs of economic slowdown. The first and foremost sign is the unemployment rate. The unemployment rate ticked up just slightly on the last report. It is still very low, and we will talk about wages here in a second, but it did tick up slightly. Okay, so we're seeing the effects of this high interest rate environment. Inflation. On the most recent inflation report, two things we want to look at. We want to look at core inflation and CPI inflation, which is consumer price index, okay? CPI is what you and I feel. You and I, when we go to the grocery store, etc., we feel CPI inflation. Core inflation removes volatile assets. This is basically energy and food, because these things move a lot on a day-to-day, or excuse me, on a month-to-month basis. So both of those numbers are still way above the target rate of 2%, okay? CPI inflation went up, core inflation went down, but they're both still above 3.5%, which means that we have a ways to go until we hit the Fed's target rate of 2%. So what has the Fed said? The Fed has said that rates will remain high for longer, okay? Higher for longer. That means that we're going to remain in a high interest rate environment. There is also most likely going to be at least one more inflation rate increase, most likely before the end of the year. So where do we go from here? We need to then talk about real estate, because I think real estate is the easiest transition because it is directly tied to interest rates through mortgages. So what's going on in the interest rate in the real estate market right now is that you have a weird situation. You have very high mortgage rates, at least for the current, for the last 20 years, you have very high interest rates, but prices are not coming down to compensate. Usually, if you have higher interest rates, you have less demand. And what did we just talk about? Supply and demand. When you have too much supply and not enough demand, prices should come down. So if demand lowers, prices should come down. The problem is that the Federal Reserve raised interest rates very quickly from near zero to 5.5% in about a year's time frame, okay, a little bit more than a year. What ended up happening is that you have a bunch of people who own homes who have mortgages at or very close to 3%, some of them below 3%, okay? Because of the speediness and the quickness that interest rates have gone up, a lot of these people who might in other scenarios want to buy a new house, want to move houses, want a pool, want a bigger house, want a smaller house, want to move neighborhoods, they are not able to, because they basically are interest rate stuck. They're stuck in their house because they have a 3% mortgage and they do not want to trade that for a 7 or an 8% mortgage. So you have a bunch of supply in the real estate market that is not coming online because these people are not selling, because they literally cannot sell. On top of that, you have an undersupply in general in the real estate market, especially in the starter home section of the market. And that is because builders are not building as quickly as they need to keep up with the current home buying demand. Right now, we have a supply and demand imbalance in home buying. There is too many home buyers and not enough homes for the current market. Now, here's the thing. Interest rates also affect builders because builders take out construction loans to be able to what? To be able to fund their construction projects. So until interest rates come down, which is tied directly to when inflation comes down, until that happens, we're going to have a real estate market which remains elevated. That means prices, I highly doubt that we're going to have a real estate market crash. I highly doubt that. We might have a small softening of the real estate market, but there is too much demand currently and not enough supply currently for a crash to be imminent. So that is the first and foremost takeaway. Secondly, when are we going to see relief in the real estate market? Because a lot of you who want to buy a house, that's a major question. We are looking at least probably mid to late 2024 into 2025. And I know that is not what you want to hear, but that is just the honest truth. The Fed is going to keep interest rates higher for longer, which means that interest rates in the real estate market are going to remain higher for longer in the form of mortgages, which means there is going to be that supply that is not coming on the market, and it is going to be harder for builders to build because they have to make money. And when interest rates are higher, it's harder for them to make money. On top of that, builders also feel inflation because builders have to buy home building material to be able to build homes. And if those materials are inflated, the prices that they're building homes for are also going to remain inflated. So the real estate market is directly tied to interest rates, and interest rates are directly tied to inflation. So you see where this is going. Inflation is the big key and the big problem that has been causing a lot of our issues. Okay, now let's move into stocks. Then we're going to move into bonds. Then we're going to talk about wages, and then we will wrap it up with the car market. Okay, so stocks are next. What do I think is going to happen with stocks? Well, we haven't really seen stocks take too much of a hit, and that is weird, and that is strange, and that is abnormal, because usually when interest rates rise, stocks suffer. Why? Well, you have to think of it this way. When interest rates rise, bond yields also go up because bond yields are tied to interest rates, okay? So bond yields go up, so do savings accounts, the yield on savings accounts. There are currently things known as high yield savings accounts, which are offering 4% and above returns. So when you have bonds, which are offering better than average returns, and then you have savings accounts, which are offering better than average returns, and both of them are less risky than stocks, usually you have people remove money from the stock market and funnel it into these other assets. Here's the thing. Stocks already took a major correction about a year and a half ago. Stocks took a huge correction. So I think that's one of the reasons why we haven't seen stocks take some nosedive. 2, corporate profits are holding stable. And 3, yes, bond yields are right now lucrative. But remember, bond yields and bond prices are inversely correlated. That means that as bond yields go up, bond prices have to come down because bonds pay a fixed amount. So, this is interesting. Because of interest rates and because of the Federal Reserve's policy where interest rates are going to remain higher for longer, I do believe that there is a caution in regards to purchasing bonds. So people who would have otherwise removed money from the stock market and put it into the bond market are cautious because remember, higher interest rate environments means that yields are going to remain higher for longer, which means that bond prices are going to remain lower for longer. Okay, so that's something to take into account. So I think that's another reason why stocks are not going crazy or crashing or anything like that. Moving into 2024, I don't think stocks are going to do much. I think they're going to teeter around, and I don't think we're going to get much of a move until we have a major change in policy, which means either the Federal Reserve raises policy like crazy, which is less likely, or raises interest rates like crazy, or lowers interest rates. And I do think lowering interest rates over the next year and a half is more likely. So if the Federal Reserve raises interest rates like crazy, you will see an effect in the stock market, a negative effect. But in the more likely scenario where the Federal Reserve in about 6 months to a year starts to maybe tailor interest rates down, you might see a positive move in the stock market because right now the stock market is holding strong, and if interest rates move down, that is always a good sign for the stock market, right? Because everything else, all the other assets, less return, so people funnel money into the stock market, okay? So we'll have to see, but I don't think right now, I think the stocks are just kind of going to teeter around in the range that they are. Now, we did touch on bonds, but now I want to talk about bonds in specifics. So right now, what you've been experiencing in the bond market is essentially bloodbath after bloodbath because bond prices have come down as yields have gone up, and yields have gone up because of interest rates. So what do I see there? I think that people are cautious to buy bonds right now, but I also think that if people are going to hold bonds for the long term, it might be a lucrative opportunity. You have to do your own due diligence, but it might be a lucrative opportunity because when interest rates finally start to go down, bond prices are going to go up. So you're going to get a higher yield on your bond from your initial cash investment, and you will get appreciation on that bond. I think people are hesitant right now because the Fed is signaling that, hold on, we're going to have interest rates higher for longer. Okay, so bonds, we'll have to see. Again, it's very interesting how all of this is tied directly to inflation. And until inflation comes down to the federal target rate of 2%, it's interesting to see how all these problems that we're facing all come back to one singular point, and that is inflation. And it's interesting how all that can be traced back to quantitative easing, which at first may have felt good, right? And this is what a lot of people were talking about at the time. It may have felt good to receive those payments, but it causes economic problems down the road. So quantitative easing causes inflation. Inflation is causing problems across the board. Okay, so we've talked about stocks, bonds, real estate. We've talked about inflation. We've talked about interest rates. So we need to talk about wages, and we'll talk about the car market as well. So when it comes to wages, right now, wages are not keeping up with inflation. Okay, inflation doesn't even matter if wages keep up with or exceed inflation. It's an interesting part that we have to understand. If wage growth is 10% and inflation is 8%, nobody's going to really be bitching about inflation. The problem is when inflation is 9, 8, 7, or 6% and wage growth is 1 or 2% or negative. Okay? Right now, wages have not been keeping up with inflation, and that is why we have a weird situation in the wage market as well, or in the employment market. So what you have right now is you have people that feel like we're in a recession, but when you look at the data, we're not. So you have unemployment, which is very low, under 4%, which is very good. And in a recession, you would usually expect to see high unemployment. So we have signals that we're not in a recession. The problem is the people who are employed are not being paid enough to cover bills. So it feels like we're in a recession. It is a very weird scenario across the board. And it's very interesting to analyze. And of course, as always, I always ask for your comments in the comment section, because I'm not God. I don't have a chip on my shoulder, and I don't think that I'm the smartest person in the world. I try to share my experiences, and I try to share from my degree and my years of experience. But at the same token, I can always learn something from you guys. So please, if you have a different opinion or if you want to add something to the conversation, please feel free to do so in the comments below. But it's interesting how wages, it's a weird thing because unemployment is low, but I don't think people feel like we're in some booming economy. Now, why are wages low? Okay. Wages are, you have to understand, you have to see this from a company perspective. So a company sees wages as an expense, and employees see wages as revenue, because companies have to pay it, but employees need it to buy things and to live, right? So you're always going to have this conflict of interest because of the way and the dynamic that most corporations are set up. Remember, most corporations are set up not for the benefit of employees, but for the benefit of who? Of shareholders, because most huge corporations are publicly traded companies. And when a company is publicly traded, it means that the main duty of management is to return revenue to shareholders, not to employees. So you have this conflict of interest. You have employees who need money to survive and to live, but you have companies that do not want to raise wages because that is in essence an expense on their income statement. So until that dynamic changes, or better yet, instead of trying to change that dynamic, just remember, you have to invest. You have to invest, because if you do not invest, you're not experiencing the better side of that coin, right? There's two sides to a coin. Investors enjoy it, employees do not. So to counteract, right? To counteract the wages that are not growing, one way to do that is to invest in companies that you believe in, or in a diversified portfolio like an ETF, so you can take advantage of the other side of the coin. You can become a shareholder. So you must invest. It's very, very important for your financial future. But I digress. The point is, wages are not keeping up with inflation, and you are feeling that as an average American citizen. And I think most of us are feeling that. Okay, so we've touched on most things. And it's funny how all these things, again, go to inflation. Because even wages, right? Even if wages are not growing, but inflation is only 2%, you're not going to feel it as much. And wages will maybe keep up or maybe just slightly exceed. But when inflation is at 3, 4, 5, 6, up to 9% a year ago, that's when you really feel it, because wages are never going to keep up with a 9% inflation rate, at least not in the current environment. Okay, so we have one more thing to talk about, and that is the car market. Okay, so there's a lot of people are saying that we're going to experience a car market crash. Why? Well, a lot of the data is saying that we have an oversupply of cars being built right now, roughly about 5 to 6%, which equates to about 5 million cars being overbuilt. And again, supply and demand. More supply than demand, prices go down. I'm not quite sure if we're going to see a car market crash. I'm less inclined to believe that. because again, these companies also know what they're doing. All these major companies also know what they're doing. What I do believe is I think that when you look at the graph on car prices, we are at extreme highs right now when it comes to the average sale price for a car. So I could see the car market and the average sale price for a car come back to normal, come back to earth, because right now it's been in the stratosphere, but I don't necessarily know if it'll go below that line or dip into some car market crash. So those are my thoughts on the car market. I do think that if you are in the market for a car and you can wait, then it potentially might be a good idea to do so. But I'm not necessarily certain if we're going to see some major crash where prices plummet. With that said, out of all these subjects, car market is the one that I care about the least. Okay, I spend most of my time analyzing investments, analyzing the economy in general, and focusing on those things. The car market, I don't spend a lot of time analyzing. So if you have expertise in the car market, if you are a broker, or if you're a dealer, or if you've really done research, I would love to hear your thoughts in the comments, because that is not my area of expertise. And again, I do not have a chip on my shoulder. I want to learn here just as much as I want to share my experiences. So if you have expertise in that or in any of these other things that we've talked about, please feel free to share them. With that said, I think that wraps it up. I just really wanted to provide you guys with a good in-depth look at what's going on in the economy and where we're going on into 2024. So to wrap all this up, we're going to be in a higher interest rate environment for longer. And all of our economic problems are not going to solve themselves until inflation is under control. So we must hope that these interest rates work. And we must hope that inflation comes down. Because if we want to see relief in any sector, it's going to come from there. With that said, I hope you enjoyed the video. I hope this was helpful. I hope it was informative. And if it was, if I gave you something, all I ask in return is for you to please consider subscribing. It does help the channel tremendously. This is a relatively new YouTube channel, and it's something that I'm passionate about. So please consider subscribing if you haven't already. And please feel free to turn on the bell notification so you don't miss the next video. Usually I release videos on Tuesdays. But sometimes I release a video on Wednesday, Thursday, or Friday, like today's video, which is being released on Friday. Happy Friday, by the way, when there's something important that we need to talk about, etc. But most of the content on here is on Tuesdays. Other than that, I love you guys. I love this stuff. It's been my passion for over a decade, and I love being able to share it with you guys. And again, my name is Derek, and I got my degree in finance, so you don't have to. I will see you guys in the next video, and I hope you have a fantastic weekend.